So currently in our taxonomy, we've got these 4 entity types. We still have to add super fund here. And that's all handled from here. So when you select these different entity types, you will end up with slightly different patterns in your chart of accounts. If you have a look over here, the most evident difference will be found in the equity section, where in this case, because it's a company, you'll find that this really is designed for a company. So let's dive back into that chart of accounts, and we'll start with the company. Have a quick look through there. It's a flat list all the way from assets right down to expenses right at the bottom. Let's start with our assets. So what you'll notice is you've got current assets, non-current assets, and then you've got liabilities, current liabilities, and so on and so forth. So given that this is a company, let's have a look through, see what we've got. We'll start over here with the current assets. We've got accounts receivable, accrued income, cash and cash equivalents, deposits and holdings held, government taxes. Now, I'm not going to go through all of these in great detail. I really just want to point out some of the most important things here. Now, obviously what will be happening is when you classify, because you must always classify to the lowest level. In the case of bank accounts, obviously that means that when you are inside your LodgeiT system and you're classifying something like CBA, you classify it into the bank account sector. That then means that you can still expose your line items in the final set of accounts that you build with our reporting tools. You don't necessarily have to simply display it to this level. These are really category holders where you can pretty much classify your accounts to and display them through. Now you'll notice that we do quite a detailed breakdown for all your government taxes, particularly around the ATO. Inventory, we don't have a lot of granularity in inventory, so if you do have the differences between, say, work in progress, inventory on hand, that sort of thing, you simply drop them into the category and you can expand the category in the final set of accounts. Non-current assets, but most important here to note is that when it comes to fixed assets, a lot of this has been set up along the lines of fixed assets from a tax perspective. Now, our long-term goal is that we won't have this granularity, because really you'll deal with this at a tax level, and what we'll really end up having is just plant and equipment and land and buildings, and you'll be and motor vehicles, and you'll be classifying into those. Things like, for instance, small business write-off, general pools, small software pools, that sort of thing, will all be dealt with through your tax software. So, or the tax return actually. You won't deal with it so much in the depreciation area. So you'll carry on doing your accounting just from an accounting standpoint. But just bear that in mind, because this will actually all change in the 2024 financial year. So once we implement 2024 tax returns, this will all be simplified down to those few elements, and you'll break out, if you need to, for tax purposes at a tax level. It'll just simplify all of this and make it easier to manage your fixed assets. Now again, into your intangibles, you've got all the different intangible types. And you can also see here, you can break out between the cost element and the accumulated amortization element. Through your liabilities, again, these are payable, noting that we saw them earlier from a receivable standpoint in case the values had switched around. Now we'll have a look into the equity section, and as I mentioned, from an equity standpoint, you've got reserves, retained earnings, and share capital. Of course, under share capital, you can classify any line items, whether those are ordinary shares, any special class shares, or whatever, it doesn't matter. You just put them under this category. All those things to do with retained earnings, including current earnings and historical earnings, will be classified under these categories. Of course, your dividends would be a debit, so these would be classified through here. Prior period adjustments, all of these things that impact your retained earnings classified into this sector here. And then on into revenue. So we've got a trading revenue category. You can classify any of your sales line items through there, any investment revenue items through there, any other revenue items. And you can see here, because our taxonomy only has revenues and expenses, there's no gains and losses, and hence gains and losses are dealt with through the other revenue section. But in the final reports, you're welcome to break out gains and losses, report those separately so that they don't necessarily have to sit with the revenue. So we do have a template for that. Increasing balancing adjustments, it's really a tax thing again. Really from an accounting standpoint, you'll really end up with profit and loss on disposal, and then you'll be dealing with increasing and decreasing balancing adjustments through your tax software. We've got obviously direct costs, which will cover for all of those things, including running a farm, recording accounts for a farm, and down on into indirect costs. Again, in the indirect costs, you're going to have your decreasing balancing adjustments. So the way we've sort of thought about it is gains in the revenue section and losses of any type through the expenses or the indirect expenses section. Noting all of this to do with tax, right? And as I said, we'll try to make it more simple in the new financial year, where we'll just be dealing with this from an accounting standpoint. So there will really just be profits and losses, and you'll do all your tax stuff through the tax only. Depreciation, same concept again. Currently, we built our system on the basis that you do your tax accounting in the accounts. That's going to change in the new year, and you won't end up with all this complex granularity here. You'll really just end up with whatever. Really what you'll want is you'll always want to have a depreciation line item for any category group. So if you've got motor vehicles at cost, you want a depreciation account for that. If you've got plant and equipment at cost, you'll want a depreciation line item for that. So try to keep your depreciation line items in the downstream software, QuickBooks Xero, Maya, whatever, independent and aligned with whatever asset group you're dealing with. So now I think what we can do, you can obviously have a look through all of these. You've got your different tax expenses at this level, but let's now look at the equity sections in each of these different entity types, because I think that's the most important thing to note. So equity for a sole trader, again, you've got retained earnings, but in the case of the sole trader, you're going to have the capital introduced by the sole trader, the drawings of the sole trader, any opening balances there. The closing balances will be derived value. Company, I've been through. Partnership. So partnership, we've got partners equity with your, and here we do actually have a closing balance, because there's a possibility that you do your accounts and just have a single line item in your downstream accounting software. If you do that, then you just classify everything there. But if you use your opening drawings, share of profit, etc., you're not going to need a closing balance, because it'll be a derived calculated balance from the other values. Of course, you'll need to consider your retained earnings in there as well, because let's just say that you're in QuickBooks, you've got drawings, you've got share of profit, and I'll talk to you about breaking out the share of profit in a moment. In that case, what you'll want to consider is that the retained earnings plus these items give you your closing retained earnings for your partner. Oh, sorry, for your partner. And on into trust. So for trusts over here, we've got the equity section where, don't forget, with a trust, you really just have the settled sum, and then all of the profits are appropriated up to the beneficiaries, and the beneficiary line items are up in the liability section. So you'll find that in LodgeiT, and I'll show you in a moment. I'll jump over there to the help guide where you can see how to handle accounting from the point of view of a trust. But in the liability section, we should have the line item for beneficiaries. So again, I'll explain this in a moment. We'll go through that. But anytime you're breaking out profit, the best way to break out your profit is to do the following journal set inside of QuickBooks or whichever system you're using. You'll create a line item in the equity section and you'll call it profit appropriation. You'll put a debit there, and then you put a credit to the beneficiary loan account to attribute the profit share. So we've got retained earnings, and we've got, so transfer to reserves. We should have one more line item in here. Let's just have a look. Might have something missing there. So let's go to have a look at a trust. It doesn't really matter. We'll go to any of our trusts and we will have a look in the account section and just see if in the equity section we've got a profit attribution account, which would be under the retained earnings, because essentially what you're doing is putting a debit into the retained earnings to move that profit up to the beneficiary. So there you've got profit attribution, and here in the trust for equity we don't see that, but it is there. So you've got it there. I'll get this fixed up, but really you'll create a line item in your, as I said, QuickBooks, and that line item in the retained earnings section will be for your profit attributions. It means that if you do the profit attribution from a retained earnings rather than out of your profit and loss, at least you can look at your profit and loss reports and see that there is profit there. Because if you use a profit attribution account in your profit and loss and you put a debit there, you're going to end up with no profit or loss. It'll just be zero profit. So it's not the best spot to try to do profit attribution. Now, I mentioned I'd come along and have a look here in our help guides to show you where to find how to carry out your accounting for a trust. So you do have this trust beneficiary loans in QuickBooks, but actually the better one to look at is options for trust beneficiary loan accounting. So that's over here. Let's jump in there, and I'm not going to go through it in detail with you, but I just want you to know that there is 2 videos here. So you need to have a look at this. There's an option A with pros and cons, and an option B with pros and cons for how you carry out your your accounting, setting up your line items, etc. in your downstream accounting software applications like QuickBooks, Xero, MyHub, etc. It's quite important, especially if you want to use trusts effectively in LodgeiT. So just going through those gains and losses, let's have a look at the elements that can create gains and losses. You've got your capital gains, you've got your increasing balancing adjustments. So really that's the recoupment essentially on depreciation in the case where you've disposed of a depreciating asset and the disposal value is greater than the written down, or greater than the written down value. So it's essentially up at least until the cost level. That's your increasing balancing adjustment. And you'll know that at least in the tax return you've got to deal with that. Now, as I said, in the 2024 tax returns, you'll do that all in the tax system only. And then your accounts, you can simply have profit and loss, which will make life a little easier. You've also got this concept of other comprehensive income. So if you're marking to market, then your unrealized gains would go to something like other comprehensive income. Then you've got the same through your expenses, capital losses, other comprehensive expenditure, and decreasing balancing adjustments, where of course you've disposed of an asset for less than the written down value. See how that will impact and affect the reporting. So what I've got here is a template, and what I've done is I've tried to separate out the gains and the losses. So you'll notice that instead of seeing the gains in other revenue and the losses in the indirect expenditure section, we've created gains losses sector, and we've got both the gains and losses. So decreasing, actually here we've also included the foreign exchange gains and losses here as well. Now, how that would work from a reporting standpoint, let's just have a look at the client, which I have now imported into the financial section, this set of accounts. So I've used our Excel template, and you can see in here I've got gains, and down here in the expenditure section I've got losses. So losses. Now how that works is obviously I've classified those line items accordingly. So gains and our losses would be, let's see if we can find the losses in here. And then how that actually comes out when we bother to generate a report. What I'll try to do is I will just show you the standard reporting and how that would look. So we'll use our standard non-trading, actually trading. And see how that looks. So of course in here now you're going to have you have your other revenue. So this is capital gains. Okay, and then in your expenses, because that's actually in a different time frame, and you can't do multiple time frames in here. So let's in the basic reporting you can't do multiple time frames. So let's do a report also trading, but this time we'll do it as that financial year set. And I think we've got a loss in here. So capital losses, there you go. So that's how you would see things reflected if you're using our basic reporting. Now, if you wanted to try a more sophisticated method, then you could add and try with, now this is a set that I've actually created. You can learn how to create these in our training course. You obviously want to change that. So we've changed that, and now what we'll have is a gains and losses report. Now what I'll do is in this one I will change it to for 3 comparative periods, and let's see how that looks. Now what we've got is we've got our 3 comparative periods, and these are all noted. So you can see here in the gains and losses, if you want, you could just have that uplifted like that, and then you've got your gains and your losses, and you could jump over to your notes, and in your notes you're going to see what those are. Now at the granular level, this is what you could expand it out to if you wanted, and you can see here that what we've done is we've got gains. So in the 2020 year we've got gains, and then essentially less. So gains on trademark and losses on share portfolio for a net value of 38,666. Now what you will note about the way we've built the LodgeiT expenses taxonomy is I'm scrolling down to human resource costs. So this is one that gets people. And what we've got down here is categorization for those costs which relate to human resources. So everything from contractors, fringe benefits tax, payroll tax, everything to do with your human resource costs embedded in here, including salaries and wages. Now, it's possible that your software is not going to break this out nicely for you. So either you're going to break this through a journal or you're going to handle it manually when you get into the tax return, because there is a section in the tax return where it asks for payments to associated persons. So either you break this out, as I said, using your payroll module and sets of accounts in your downstream software like QuickBooks Xero MYOB, i.e. actually create accounts for associated persons and wages for other, and then duplicate that function through your superannuation. But what you'll notice is in here we do have something like other human resource costs. So there are going to be a ton of different costs, like let's say staff amenities and protective clothing, which we don't actually have categories for. The reason for that is because you put all of, and there are actually quite a few other ones that you could have in there as well. Now you simply create your line items in QuickBooks Xero MYOB or whatever, and then when it comes time to classify, you classify them in here. Okay, so I'll now show you how you handle that when it comes to generating your accounts. Right, so staff amenities, protective clothing, superannuation, wages, and what we'll do is we'll save that, import it. Whoa. Okay, so might have just lost my connection there for a moment, but seems all right. So let's keep going. Import, and in my profit and loss, what am I going to see? Staff amenities, protective clothing, just those line items out of Excel. Could have easily have been QuickBooks. Let's check our classifications. So you can see what I'm doing here is I'm trying so Control F will help me find, so other human resource costs, protective clothing, also to other human resource costs. Now what we'll do is we'll go and build a report. So we'll start from scratch. We'll use our trading entity for 22. I think that's the year that we've got these line items. And comprehensive income. Let's have a look. So here you can see all of this under human resource costs. If you don't like that idea, and of course you could see these nest under that line, right? But if you don't like this idea, it's very easy. Just ungroup them. And then what have you got? You've got you just won't see that if you generated that in a final set. Let's actually just print that out so you can see what I'm talking about in the final set. Okay. I think we should find them in here. And there you go. So you'll just see it like a normal set of accounts. Now, of course, what you could do, you could very easily go into the templates and go and learn. We've got some training videos on how you could create templates and how you would open up that report so that it's consistent, that every time you generate a set of reports, financial reports, it will consistently break out human resource costs, and you won't see our taxonomy categorization in your final reports.